Good evening, ladies and gentlemen. Tonight, I wanted to take you through kind of the top 10 Canadian dividend ETFs, not just dividend oriented, but the fact is most Canadian ETFs pay pretty healthy dividends because that's the vast majority of the Canadian stock market. I was making jokes with somebody that, the S&P 500, their primary indices consist of like 500 companies. In Canada, we have something called like the TSX 60. Most ETFs here in Canada don't hold much more than 50 or 60 stocks, even the broad-based indices. But I think it's going to give you a further in-depth look into the ETFs that do exist in Canada because it's not a one-size-fits-all shoe. We're going to start with my favorites, of course, but then we're going to take a look at some sector-focused ETFs. We're going to look at some high-interest savings account ETFs and just take you through the rung of what I consider to just be the top 10 Canadian ETFs that I personally like. And at the very top of the list, and I want you to kind of understand why this is my favorite as we break down these other ones, but I'm always coming back to VDY. This company or this ETF just kind of encompasses everything that I want in an ETF. A doubling of the dividends over a decade, the stock price, giving you hopefully a healthy doubling up as well. I usually like trying to get that combination of getting a full rate of return out of the stock over time as a historical average and getting dividend growth that is at least doubling. And I think VDY comes to the very closest of this. I mean, we're not exactly at a double because the market's kind of corrected since 2014 here. I mean, from peak to trough, probably looking at about a 58%. So, I mean, for Canadian stocks, this isn't so bad when we're comparing it to the broader indices. So you're kind of, lacklustering on the growth of the stock because of the insane amount of income that you're making off an ETF like that. And we're going to take a look at the holdings here because so many of you know this ETF, but it's one of those few monthly paying dividend ETFs that we're going to compare to that have at least kept up with the doubling of the dividend. Because if you went back a decade ago, you'd be looking at around 9 cents to probably about 6 cents on that average for a monthly from like peak to trough to today, we're getting about 16 to 18, I think on the peak 19 cents. So you're definitely at the doubling point of a decade for a monthly paying ETF is pretty fabulous. And considering this ETF does weighting by basically the same way most of the US ETFs work, is like passively weighted based on market cap value. So there is a lot of changing going on with this ETF as well, which I showed you guys in a recent video here, that if this loads up, we can agree to this and get in here. You can kind of see first and foremost, dividend is about 4.71%. You're paying a 0.2% management fee, which is going to come in the middle of all the ETFs we're going to look at today. But with a 4.71% dividend, you're going to get about, what is that, 4.5 after the management fee, which is pretty good. And if you take a look at the holdings, what I like to see here, you can see Royal Bank and Toronto Dominion, top two, Canadian Natural Resources. Enbridge is slowly slipping down because it hasn't been performing so well. We're seeing an upper weighting in Manulife. And if these kind of stocks continue to trend the way that they are, we'll probably continue to see some averaging in and out here. Bank of Nova Scotia has been coming back a bit nicely here because it was sitting at the bottom of this list not that long ago. Now that stock has been bouncing back as well, we're sitting in a pretty good place. But that's what I love about these ETFs. They remove the idea of self-management. Obviously, you could build your own Canadian dividend portfolio because there's so few companies to work off of. But that's just give you an idea of that one. The next best comparable for most people is an ETF called XEI. XEI, this one, I'd probably put it in second place, though its history, I don't know why it lacklusters at best, especially with the dividend side of things. Because before we look at the holdings, you take a look at the dividends. 10 years ago, you were getting about 8 cents. Today, you're only getting about 12 cents. So I haven't fully been able to figure out why or what kind of allocation sets have been made or remade that have caused basically zero growth in the dividend side of it and not a whole lot of growth. I mean, the last decade, you're probably up maybe 20-25%. So it doesn't kind of give that same oomph. But the difference between this one and some of these other ones is the dividend yield starts much, much higher. If we just take a look here, we can see that the starting yield on this guy is 5.69%. So you're kind of giving up a bit more growth, but you're starting off with a much higher yield. And this is kind of that compromise I don't like seeing people make. You make those compromises too early on in an investing career, and it only hinders the long-term value of your portfolio growth. Because again, in 10 years, if you can just own an S&P that'll double or triple up for you, you can sell it and buy an ETF like this when you're more oriented toward income. But the top holdings here include Suncor, Canadian Natural Resources, Royal Bank, TC Energy, Enbridge, a lot more diverse as well, not passively weighted based off market cap. And I really like Vanguard's system of market cap weightings because it always seems to bode better for long-term results. We got TELUS and BCE in here as well. And I think it's important to point out that the management fee also is roughly, it is exactly the same. So I don't know if the trade-off is exactly there. This is why I've always been leaning more toward VDY, but we also have the iShares Core MSCI Canadian Quality Dividend Index. This one I think offers probably a bit more stability, a bit newer of an ETF. It's only been around since 2017, but since 2017 has had pretty good performance, up 30%. The dividends with this one also a little bit more up into the right in comparable to XDIV, but not as stable as VDY. About since it IPO'd in 2017, you're getting about 7 cents a share. Today, you're getting about 13. So almost the doubling of the dividend there in a pretty short period of time. But we did go through these slump periods, which I'm very curious to what caused these. Because if we take a look at the holdings here, you know, most companies, even during the pandemic, did not cut their dividends. That would be in the top weighting of, you know, a lot of these dividend ETFs. So I just find that kind of intriguing. And if we take a look here, why not scroll down? 5.91% dividend. That's insane. That's a very high starting yield for an ETF, almost 6%, with a lower management fee of 0.1%. So you can start seeing this being a bit more intriguing. But the top holdings in this one, you know, they're huge. There's not a lot of companies in this ETF, right? Because you got Suncor, Royal Bank, Pembina, Sun Life Financial, so some insurance, Fortis, great company, Toronto Dominion Bank, Manulife again, Emera, Great-West Lifeco, and TELUS. But you can see that this is almost the majority of the ETF because almost all these top holdings make up about 10%, except for the bottom three. So a lot more weightings in here, but still fairly diverse. You know, they basically concentrated the weightings, but gave you a little bit more diversity still than some of these other ETFs, 42% financials, 22% energy, 17% utility, some communications in there as well. So a lot of people like these three primary ETFs. I think most investors you're going to talk to in Canada, if they're talking about dividend ETFs, it'll be one of these three primarily. Now, you don't have to go this path either, because if you want total return, which you should care about most in the early days of your investing career, we're going to talk about sector allocated ETFs and then the broader indices that are more related to like the TSX 60. And VCE is your Canadian counterpart of VOO or the VFV. For a lot of Canadians that like buying the S&P 500, this is the closest comparable on the Canadian side of the border, which is VCE, the Vanguard FTSE Canadian Index ETF, up 95%. Basically, since it came out around 2011, since 2014, have we got a doubling there? Yeah, about 71% with the dividend. We take a look here, also pretty good performance from 19 cents a decade ago to today. We're getting about 38 cents. So yeah, pretty much a doubling of the dividend over that 10-year period, which is very nice to see, but it's an indice. So, I mean, would you expect much less? If we take a look at the holdings here, you're going to find that just like S&P 500, it's just going to be market cap weighted, which you'll also notice some real big crossovers between this ETF at VDY, because I think they're both so similar in the way they hold stocks, because you can see Royal Bank, Toronto Dominion making up the top two, but this is where you get some of those tech companies like Shopify, Canadian Pacific Railway, Canadian National Railway, there's Natural Resources again, Enbridge, Bank of Montreal, Brookfield Corp, Bank of Nova Scotia. So I'm finding that the performance of these two ETFs are fairly similar with VDY, because when you look at the yield, you're only getting about 3.14%. So you're giving up like 1.5%, almost 1.5% on the dividend side of things. So over that decade period where we're getting kind of, VDY has better dividend growth in comparable, but like I said, it just depends on what you're after here. I like both these ETFs if that's what you're going for, but VDY will always be a favorite of mine because, I mean, I could give up some of those stocks. Again, there's a lot of growth in the railways and some Shopify-like stocks, but I still believe that there's some overvaluations in the tech sector in Canada, which always makes me a little less hesitant to want to buy just broader indices that hold a lot of those tech companies, which we're going to look at in a sector-focused ETF in a moment. But you can also just buy something like XIU, which is exactly the same. It's BlackRock's version of VCE. Also very stable performance, and it should be almost exactly the same because they hold the same stocks. 14 cents a decade ago, you get about 25 cents. So this one not quite doubling over that decade. Still not bad, though. I mean, the lowest you're getting at 14 cents to 25. So not exactly the same performance, which also would put, you know, VCE kind of in the upper realms of better, broader ETFs here in Canada. But let's just take a look here because this one as well paying a 3% dividend yield. So you're getting a bit less of a dividend on this one. And I think the other ETF was 0.05, whereas this management fee is 0.15. And let me just double check that to be sure. Yeah, so there's major differences in the management fees. So you're paying about 0.1% higher than you would be buying VCE, and you're getting kind of less performance So it's always important to kind of pay attention to that, because at the end of the day, you want to pay if you're going to pay a higher fee, you want to be paying for some form of performance. But again, all the same stocks, just slightly weighted differently. And you're just slightly, just some slight difference in some of the weightings here. But yeah, I mean, you could pick either or. They're all great ETFs. I think the difference too is that BlackRock's XIU has been around quite a bit longer than VCE, but that leads me into some of these more core focused ETFs. And one of my favorite thus far amongst all these ETFs, and this one I've been debating on, I think is a great ETF for people that are looking for growth and stability. It's called the BMO Low Volatility Equity ETF. And since kind of the same history, this one's done exceptionally well, far better than a lot of them. I mean, in the last decade from 2014, this one has met the criteria of at least doubling, actually over doubling, which is much better than VDY and much better than the broader indices. But like I said, we're going to do some comparisons here because it is quite a different ETF. You're talking about 12 cents 10 years ago. Today, you're getting 28 cents, so well over a doubling of the dividend. So my goodness, it's like a 2.5x on the dividend, right? So let's take a look at this ETF and just see what the comparable differences are. I stumbled upon this one quite a few, I think about a year or two ago, and I've been following it ever since. The only thing that's kind of keeping me away from it to some extent was the management fee, but you have to kind of keep in mind that, you know, sometimes it's worth paying a slightly higher management fee if you're getting that performance, because again, it's passively weighted that way, and it kind of removes your own kind of psychological risk of owning individual stocks. But the fee on this one is 0.35%. The expense ratio, I mean, it's it's fairly high and comparable to usually what I like to see, but compared to most mutual funds that charge upwards of 1%, 0.39% really at the max is not that bad. You can see that you're only getting a 2.57% dividend yield. So that's probably what turns most people away from looking for income. But again, that is a very great yield for the fact that you're outperforming the indices and you're getting much, much better dividend growth. So let's just take a look and see what this ETF holds, because honestly, they're pretty great stocks. I think this ETF, they have 53 holdings, so very similar to some of the bigger weighted ETFs. But if you take a look, we got Loblaws in here and Metro at the top two, 4 points, almost 4% between the two of them. You got Hydro One, Waste Connections, Thomas Router, Empire Company. You got Intact Financial Corp, Fortis, TMX Group, Fairfax. So companies that you're not exactly used to seeing in Canadian ETFs. These are like some very renowned stocks, like super stable companies. And it'd be fun to kind of go through the prospectus of this, this ETF from BMO and get a full understanding of like what metrics they're using to find these companies, because their primary goal is to remove volatility. And you're kind of getting that through diversity here as well. 19% financials, 16% consumer staples, 14% utilities. Like, what a great ETF. I mean, it checks so many boxes for those that are younger, that need a little bit more growth, but want that exposure to the Canadian economy. I think this one does fabulous jobs on so many metrics, which leads into the second one here, which is the BMO Equal Weight Bank Index. This is probably one of the also primarily best ETFs you can buy, because the biggest sector in Canada and the largest companies in Canada are all financial. And you can see this one has a lot of stability behind it and has been around for a long time, right? I mean, you've gotten over a doubling of your money pretty much in the last decade. From 2014, this thing's up about 72%. Okay, so maybe not an exact doubling from the peak to trough. If you bought it in 2014 at the beginning of the year, you'd be pretty much up 100% to the peaks of 2022. We got a bit of recovery going on here, of course, but let's just take a look at this one. And this one as well with the dividends. 10 years ago, you would be getting about 6 cents. Today, you're getting about 14 cents. So again, over a doubling of the dividend. And let's just go back here and take a look. You're going to be paying about a 0.25% to 0.28% fee for an ETF like this. For 4.67% dividend yield, that's not bad, right? To get that kind of performance, that kind of dividend growth, again, not bad at all. But you're kind of giving up diversity, right? Like, you're kind of putting yourself into a little bit more risk because, again, you're just buying banks. This is an equal weight. There's only 7 holdings in this whole ETF. And you can kind of see they're Pokemon cards. You can just collect them all yourself if you'd like, or you can buy an ETF like this. If you're not comfortable buying the Canadian banks on your own, which is something that I always debate with, like, you can either buy them through VDY, largely weights the best banks. You can buy these ETFs. You can buy them individually. It's not, in my opinion, for an ETF like this, it's usually not worth paying such a high management fee. 0.25%, in my opinion, is a bit extreme to pay somebody to manage 7 stocks. It seems a little bit extreme, but you can buy the counterparty that's my favorite right now, which is the Horizons Equal Weight Bank ETF. This one has 0 management fee, I believe, until summer. This one's only a recent IPO, and their management fee, I believe, is going to be of the lowest of most Canadian indexes, because when they do come public, their starting fee is going to be 0.09%. So it'll be less than half than what BMO is currently offering to basically hold the same 5 or 6 or 7, banks, basically. So I like this one a lot. So you can see Toronto Dominion, Royal Bank, National Bank, all the same banks, all equally weighted. So you kind of get the same performance. If you want to own this, it's probably the best way to go. And let me just make sure that's right. Yeah. So till July 31st, if you buy this, there are 0 management fees. Probably one of the best equal weight bank ETFs that exist in Canada, and one of the best ETFs, bar none, just for the lack of management fee and getting exposure to those banks. That leads into the other sectors that I don't like to talk about as much, because again, I think Canada's tech industry is mostly a bubble, worse than probably the US. So I avoid these ETFs, and it kind of comes with that. There's valuation disconnect with the volatility that comes into downturns in the Canadian markets. I mean, over 5 years, you got 146% return, which is fabulous, but you gave almost all of that up during the interest rate cycle that caused this kind of black swan-like event. Because I mean, this was down 50.89%, incomparable. I mean, let's just pull up the Qs real quick and just take a look at more of a tech-focused US ETF, right? If we take a look at the Qs over 5 years, your rate of return was roughly the same, but you're taking a look at a lot less volatility, and this ETF is now up from its all-time high. So you would have only saw a peak to trough of about 34%. So very, very different in the performance of these two ETFs when it comes to their tech holdings. And again, I mean, if you bought it 5 years ago, I mean, you very likely could have wiped out most of those gains. So nobody really knew this was coming back the way that it did. But let's just take a look at the holdings. We kind of just dive in here. Firstly, the management fee. What do we got for fees? No distribution, no yield. I think the fee's down here. So we're not getting a dividend from this. So we're purely buying this for growth. We're paying a very high management fee of 0.55, 0.6. Very high management fee to own Shopify, which makes up 26% of the holdings in Constellation Software. So you can see this ETF, you're paying somebody a very high management fee to basically hold primarily 2 stocks. They almost make up 50%. They do make up 50% of the entirety of this ETF. Next in line, you got CGI, you got OpenText in here. But yeah, I mean, these top 3 holdings are just insane for the weightings that are controlling the vast majority of this ETF. So I don't like this one. It's very volatile, very concentrated, very high management fees. I'd much rather buy something like the Qs. Now, kind of moving in the other spectrum altogether, that's when we get into these cash flowing oriented ETFs. And these are something that I've been, looking as a proponent for more or less a retirement focused person, or if you have cash as an emergency fund. Usually you can put it in your own high interest account, but you're probably not going to get the same benefits that you would from owning an ETF like this. Now, these ETFs come with 0 volatility. It looks like there's a lot, but trust me, there's 0, because you usually pay a flat rate of $50 to buy this, depending on where they add on the interest rate cycle. And as the dividends come in, it's added to the equity, which is what you see in the volatility, like a lot of dividend companies, but they pay it out. So basically the flat rate of the ETF coupon or whatever they're selling you here is $50. It'll never go up or down below $50. And then anytime dividends and interest come in, that's what the volatility you see here is. And then they just pay it out. That's it. It's a beautiful thing. These guys go out, they take your money, they find the highest interest promotions on all the banks, and they just manage high interest savings accounts for you. And you can see that they've been growing dramatically in the interest raise cycle. So these ETFs are something that do have a special place in my heart. And if we can find, let me just see if I can find it here. Let me look at the other one, because this one isn't coming. I'll have to dig for it. But there's the other one called the Horizons High Interest Savings ETF as well. So you have 2 of them in Canada here that are great. You can also get exposure to the US side of the border with these. But if we take a look at the holdings in here, firstly, management fees amazing at 0.1% for a 4.92 current dividend yield. So, like, in my opinion, as interest rates stay high, this is a great place to park cash. And as interest rates start to get cut, you can take this money and start allocating it toward long-term GICs. But the best thing about this is you have liquidity, you can sell it whenever you want, and you have monthly income as soon as you buy it. Whereas GICs tend to lock up your money, and you can't really allocate the yield over the whole year without holding it for that year. Or sometimes to get better yields, you have to lock it up for 3 years. But for the time being, this probably isn't going to last forever, and you might want to enjoy it while it lasts, because, again, most people can't get 4.92% off their bank. It's really hard to go get a dividend yield that high or a savings interest rate that high. So this company will go out, look for those promotions, lock them in for you. And if we take a look at the holdings, it'll give you an idea, and you could use this to your own advantage. But National Bank, Scotiabank, and CIBC are clearly offering the highest interest rates from their savings accounts right now. So this just kind of encapsulates what I believe to be the 10 best dividend ETFs and just income oriented ETFs. And to kind of recap, what I would compromise is my favorite. If you want income today, I would highly recommend VDY. I think in a diversified portfolio, if you're buying like US dividend stocks and Canadian stocks, that this one comprises the largest market cap weighted, highest yielding dividend companies. You get some of the best performance, the best stability, doubling of the dividend. If you're looking for monthly income, that probably the way to go, in my opinion. If you're looking for more growth-oriented income, I would focus more on the broader base indices. Again, VCE comes out as #1. So for income, monthly VDY. For broad-based indice exposure, you're going to get quarterly payments. You're going to want to buy VCE. Again, just my opinion, not financial advice. You can pair that with further growth. Instead of buying the tech ETF, I'd highly recommend ZLB, the Canadian BMO Low Volatility ETF. I think this one is beautiful. Yeah, it's going to be paying the highest management fee of the bunch, but it's going to offer the most stability, the best growth from the dividend-oriented side and the capital gain side. I have a lot of respect for this ETF because it's got a lot of history, and it's hard finding ETFs that have little volatility that continue to grow at a very decent pace. And then finally, for the income-oriented investors, I would probably stay away from sector-focused ETFs as much because, again, you look at a more diverse portfolio of VDY or this ETF, like the low volatility ETF, you kind of just get rid of that stomaching crunch if some black swan event dramatically hits like the banking sector. At least these ones are going to give you a little bit more, safety over the long run. But you can pair them too. If you just have some cash and emergency fund, there's nothing wrong with buying some of these high interest ETFs either. So these are kind of the conclusions that I've rounded out to, thinking, being in the Canadian markets for as long as I've been in. But we'll maybe get into some Q&As and just see what you guys think. Are you going to talk about the RioCan? You could talk about some of the, there's also the Canadian REIT ETF. I do like, when it comes to Canadian REITs, however, I do try to avoid the ETFs, but let's just take a look. The Canadian REIT ETF, what was that one called again? I think it's, the US is what? Is it VRE? Yeah, V&Q, I think, is the US one. So let's just take a look and see where RioCan, if RioCan sits in this ETF, and then I can discuss it briefly. But yeah, if you take a look, this one, I really don't like these. I like the US one a bit better. It's the one that I would recommend over the Canadian one, because the Canadian one just lacks performance. And it's a bit, like I said, let's just take a look at the holdings. I've always felt like REITs are in and of themselves diversified ETFs. I mean, when you're buying a REIT, some of them are a little bit more focused than others, but when you're buying a company that has like $5 or $10 billion in real estate value, you're really just kind of looking at management risk. That's about it. That's the only thing you'd be diversifying away from. But you can see these REITs also very expensive, 0.35% for these kind of ETFs, not a high dividend yield. It is paid monthly, but 2.78% is not great. I know this ETF doesn't have a huge amount of ETF or dividend growth either, but if we take a look at the holdings here, you can see a real estate service company is #1. It's not even a real REIT as much as it is just a service-oriented company, probably like HOA management, stuff like that. Canadian apartment property is probably my favorite. And you can see RioCan comes up at #2 here. So you can see that most of these Canadian REIT ETFs hold the same companies. My favorite REITs in Canada by far are Canadian apartment properties, RioCan, and Granite. Granite gives you that industrial exposure, but let's just take a look at RioCan because I know a lot of people do love the RioCan, but let's just take a look on the, because it doesn't ever come up on Google Finance for the Canadian ticker. We can take a look at the Canadian ticker on Yahoo here. If we just zoom this out, let's see. Sorry, it seems to be a bit lag at loading here. I'm getting a 6% dividend. See, we still own this. My wife still's got some holdings in this. I think if we take a look at year to date here, we're just kind of popping up a little bit. Gonna have to take a look, because everyone's saying, oh, it's a good income stock that's turning around. I feel like that story comes up a lot because RioCan has always been a bit volatile, and I still think it's trading well below its NAV value. But the reason I like RioCan, even though the stock's trading down, is, again, if you're looking for cash flow today and you don't care about growth, because you can see this company has never offered growth. I've never claimed RioCan to be a good growth-oriented stock, but for something that's trading at good value, if you want the best of Toronto real estate, I think this is going to give you the best exposure with a starting yield of 6% that is now starting to grow back. I think management has done a fabulous job coming out of the pandemic, out of the other REITs, because Smart Centers is highly leveraged when it comes to their dividend. Their payout ratio is too high. I don't know if it shows it on here because REITs do have write-downs, so it might not show the dividend as appropriately. No. So, I mean, on here, you can see they're telling you that the dividend payout is 826%. That's dumb. It's obviously not. I think their funds from operation payout is like between 50 and 60%, I think, based off the last earnings. But yeah, if you're looking to buy REITs, honestly, just be careful with management. Make sure you understand that. But I would just buy them individually. I honestly, it just seems to be the more appropriate thing to do from what I've seen, like Realty Income. Yeah, some of those more oriented stocks. Is like a US dividend ETF in and of itself. I mean, you get so much good exposure, which is great. Gone from 3,500 to 70K net worth in 5 years. Big part of that's because of the knowledge you've offered in this challenge. I don't know what challenge I've done here, unless you're talking to someone else. Cole C, this challenge, you're trying to get to financial independence here. Based on the last earnings, RioCan's payout is 60%. Okay, thanks. Yeah, I figured it was between 50 and 60. They've done a good job. Honestly, that's the problem, is a lot of people say REITs have to pay out 99% of their funds, their leftover cash flow. But I don't think that is actually true to some extent, because I think they can leave it on the books too if they're going to invest it or do something else with it. Channel. Oh, it's funny. Realty Income. Yeah, everybody loves Realty. XRE, ZRE. What's the ZRE side? Did I talk about ZRE? Let's take a look here real quick. See what ETFs you guys are talking about. The BMO equal weight REIT ETF. Oh, let's take a look at this one. This one's interesting. So you're kind of just, let's take a look at one of the equal weight REIT ETFs. So incomparable, this one also not that great of performance. You come way off the highs. Again, the difference is I shouldn't be beating up on these because they're very likely good recovery plays. That's the thing too, right? But again, I really believe that long-term performance matters. Obviously, the past cannot constitute future returns, but I believe if you find something that in the past has historically offered reasonable returns, reasonable dividend growth, and they're holding good companies like the BMO equal weight ETF is, look at the management fee on this. You're getting into the 0.55%. I mean, the BMO equal weight ETF, yeah, you're not getting 5.3%. You're getting half of that, but for the rate of return you're getting is so much better. So yeah, like I said, these management fees get out of control. I really don't like paying anything over half a percentage point if I'm going to have to pay. And again, you're only getting 22 stocks, very concentrated. You get Northwest Health Properties. That's a surprise. Northwest has been beaten into the ground. Have they been coming back a little bit? Northwest Health Re. Let's just take a quick look at this guy. This is like the Canadian version of Medical Properties Trust, and it's just been getting hammered. Interest rates were killing them. Yeah, I mean, you look at the performance of this, just absolutely. I mean, this was a stock you would have bought back here and you'd be like, oh, it's great. I've been collecting this massive yield and everything's been great. I'm up 70% on the stock. If you bought it in 2016 at the bottom, then boom, you wipe out 50% of those gains. There probably goes half your return in dividends as well. Just super painful. But a lot of people think it could be a good buying opportunity, right? Because now that they've been beaten into the ground, there could be some good comeback to them. So, I mean, that's the kind of risk because they've been so beaten up by interest rates. That, because a lot of these companies took on, loans that were probably variable to some extent. Because, man, I think they've seen over a doubling in their interest payments. Last time I think I looked through it. But you have Artis Real Estate in here, Boardwalk, there's Granite again, there's RioCan, Chartwell, Choice Properties, H&R, which is another popular one here. Slate Grocery I always find interesting. How has Slate been performing, actually? Slate Grocery REIT. Let's just take a quick look. Kind of curious here. It's been a while since I've seen that one. What's the ticker on that one? Let's just pull it up on Yahoo. Yeah, this is one of those grocery REITs I was always intrigued by. How's it been holding up? Yeah, it's been trading down, but actually not bad since IPO. I mean, it's pretty much at its IPO price of around, what is that, like $11? It's not too far off, around that $12 area. This one I've always found fascinating. Grocery REITs, could you ask for more stability? Looks like their earnings have been stuttering a bit. Again, probably related to the cycle we're in. Let's take a look at the balance sheet real quick. On this guy, we're talking about 1.3 billion in assets. That's liabilities. 1.3 billion liabilities, 2.2 billion in assets. Not bad. Just it's not terrible. It's not like a 50-50 ratio, but it's not terrible. But yeah, interesting. Something to take a look at. What else we got here, guys? What else is going on here? Thoughts on Allied Properties? Allied Properties, I guess they've done a huge rebalancing, haven't they? Because I know they have a stake in a lot of the same properties that RioCan has with the Well. I think there was 2 or 3 companies that had a stake in that. But let's just take a quick look and see how it's been performing. I really hate Google because as of late they've only been showing me the OTC tickers, but we'll pull it up on Yahoo because this one's also been just clobbered into the ground. I think they sold some assets too to kind of rebalance, didn't they? I think we're talking about 2.2 billion. I think this one is one of those odd ones where they had like hardly any debt too. Let me just take a look. I'm pretty sure this was one of the ones I was looking at where it's kind of laughable because their balance sheet was so clean. 10.6 billion in assets and only 4.4 billion in liabilities. Yeah, I mean, beautiful debt to asset ratio, right? That's crazy. And then you take a look at their market cap, right? So NAV value, if you minus 10 from the 4, I mean, you're looking at like roughly 6 billion in assets, right? And the current market cap value on a company like this is 2.2 billion. So, I mean, you're getting it like almost 3 times below its NAV, I think, which is crazy. So again, like this is the scary thing with REITs is they don't trade against the underlying asset value. But it's funny, kind of, you look at these and you're like, how is this possible, right? Again, don't trust the payout ratios. I'll have to dig into it because I haven't looked into the recent earnings, but it'd probably be a good one to follow up on because even looking at the right here, I mean, their net income dropped off on that Q4 by the looks of it, but still very stable across the board. I have to do some research. I'll add that to the list and maybe do an individual video on it. Slate assets are all in the US too. Yeah, I think they're all US oriented, but you might have to be a little careful with because REIT dividends aren't qualified and they count toward as just regular income. So even though you might be getting a higher yield, it comes with higher tax liability. So something you probably want to hold in a tax-free savings account over maybe another other kind of holding account. You scared me right there saying, I really hate Google. It's only my largest position. Who's saying I hate Google, man? Google's the bomb. Gotta love my Google stock. Whoa, you hate Google. Don't say that. Gemini is listening. You guys are funny. Yeah, I don't know why people hate Google. I can't figure out when it comes to tech-oriented companies, man. Google, they're growing. They're getting back to a sustainable place of growth. And the only thing that people can hate on them for is the recent media and the woke mind virus, as Elon Musk likes to call it. But I think it's a foolish thing to focus on immaterial effects when it comes to the performance of their AI abilities with Gemini. If you just try out Gemini, even the free version versus ChatGPT, I think you'll be solemnly impressed because everyone's like, it's so much worse. I'm like, is it though? Is it? You're just focusing on what people say on Twitter, or are you trying it? Because I use it for work. I'm more or less impressed with Gemini, and I think they're going to partner with Apple. And if they do, it's game over for ChatGPT. Because let's be real, everybody uses an iPhone in the Western world, or at least the vast majority of people do. And if you don't use an iPhone, that means you're using Android. And guess who owns Android? Google. I'm like, Kyle mysteriously disappears off YouTube after that Google comment wall. It's like grocery pays the dividend in US dollars too. Yeah, but that's the problem is the better REITs are in the States, I think. There's very few REITs that, perform as well here in Canada. But let's just finish up here. Gone from based on earnings. Yeah, I know. Smart Centers is worth considering as well. It's a good one, but to put it in perspective, you got to be super careful, right? Like this is what I was telling my parents is that, when you own a piece of real estate in Canada or a very specific area, and then you're buying real estate investment trust, you're really betting the farm that the overall Canadian real estate market's going to perform well. And we won't sell RioCan. Like my fiance won't sell it because it's just we bought it so early. She's got a great yield on it. The yield's growing tremendously from her $14 buy price or whatever she bought at the bottom of the market for it during the pandemic. So we just hold it out of nostalgia, but out of like common sense, like it's a very, very small percentage of our portfolio. And I don't want to buy more REITs here in Canada anyways, because again, like we own a substantially insanely expensive condo, which, for what we paid for seems reasonable for this area, but still, when you own real estate, you can't be having like 80% of your net worth in just REITs and real estate. I think it's crazy. Some people are comfortable with it, but I think it's crazy. Kyle, Vegas, not particularly. Vegas has kind of gotten too expensive these days. I'll meet you in the Mediterranean though. I mean, let's do something cool. Let's go to Japan or Mediterranean. I'll meet you in like Rome. Let's go somewhere different. Vegas is kind of getting overrated these days. It's not like it used to be. Even in 2019, I mean, there was resorts that offered free shuttle service from the airport. I mean, I feel like, and the homelessness seems to have gotten much worse. No, I mean, I know some people that recently went, and I was shocked by what they were telling me, because when we went in 2019, it was a good time. We thoroughly enjoyed it. I just feel like they've gotten so greedy. I mean, the world has moved into a place of margins. It sucks. And that's going to be the ascending stick of I was just talking to my dad about this. We're going to go through a period thanks to AI that's going to be an output efficiency thing, where we're going to start seeing people's output go exponentially higher. We were just watching the CEO. I mean, I'm sure you watched the CEO of NVIDIA go on about, the future of AI. And he says, well, as long as you're learning about AI and you're focused on using it as a tool in your work, you're not going to have your job replaced because you'll be the one working with AI. But the vast majority of those people, it doesn't matter if you work with AI or not, you're not going to be needed, because AI is going to do, one person is going to be able to do the job of 10 people or 20 people, or get to the point of 100. So we'll go through a period of operational efficiency, and then some stupid thing in the economy will happen, and everybody will be like, we need to fire people. We need to make more margin. And they'll do what they're doing right now and just fire a bunch of people. And then we're going to go into hell. And that'll probably be 5 or 10 years from now. Vegas is fun for once. I think Vegas is cool, right? Like I could live there, to be honest. I do like it. It's fun. It's just touristy and expensive now. It's like a lot of places. Everything's kind of gotten greedy. I mean, that's the AI story too, right? Like I think AI is only coming around for a few reasons, and it's just greed mostly. I mean, do we really need, like, we know that the inevitable apocalypse is on the horizon without intervention. If there's no intervention in the next 10 to 20 years, you're going to see an absolute collapse of society. I mean, capitalism will not function in the future. Maybe I'm a little too hesitant on, like, or maybe a little bit too short-sighted when it comes to my time horizon on that, but I just can't help but believe that this isn't like the tech innovations of the 80s and 90s. I mean, we're going to talk about I always just think of, like, as redundant and as simple as it can be, the porn industry, I think, is probably the best thing to exemplify. I honestly think, watch it happen, because when it starts to happen, it's going to be crazy, but eventually there will be no need for OnlyFans or any of these porn sites, because it'll just be AI generated. Those will be some of the first industries, I think, are just going to blow people's minds away that this is happening. And then the government's going to wake up and be like, oh, man, we should pay attention now that the porn industry is wiped out. Because it's always like the stupid things that go away first. I mean, the things that are low, that have the least importance on society, but make the utmost amount of money. It's like wherever the most money is made is the first thing that's going to be gone. I, for one, welcome our technology overlords. I don't know. My whole goal is to get rich and retired before that happens, and pray to God that, like, I'll probably have to start putting money in crypto and buy some more hard assets, because the fact is owning hard assets is the hardest thing you can do today, because it's so expensive. But, like, I mean, nobody can take your real estate away from you, right? Like, nobody can take at least no one can take your crypto away from you, unless you're an idiot. No one can really take your gold away from you. And I'm not a gold bug or a crypto guy at all. But you start to understand that, like, what happens when a few control the many. Like, a handful of monopolies are going to be controlling the entire global supply of shit. I mean, it's going to be scary. It's going to be interesting. That was a Simpsons reference, by the way. Anyone else that's old like me? Well, hopefully, if you're old, you've had a good life, man. That's all I got to say. I feel like my parents had the best generation. Kyle, if you give me a thumbs up with your hand, it makes the thumbs up emoji on the screen, but it actually freezes the screen. YouTube hasn't fixed it yet. Hilarious nonetheless. Maybe we'll try that on the way out. I don't want to screw the stream up that bad. But yeah. It always comes back to the AI talk. Unfortunately, when it comes to investing, you have to be very forward-looking, which is another reason I like the Canadian economy so much. A lot of people hate the lack of growth here, but outside of the lack of growth, you get sustainability from the absolute necessities of just, you just get the necessities of a lot of utility, finance, infrastructure-oriented companies. I feel like infrastructure, when it comes to finance, could be in trouble at some point in the future. But the fact is when you're talking about oil and natural gas, energy, and those things, even though, cars are going to be replacing, probably it could hinder some of the oil industry. It's just that those commodities have such, if you're friggin' even 30 right now, you're not going to see the end of oil. I mean, it's responsible for plastics and so many things that we still use. And I kind of like having that exposure to some extent, because, like, tech companies could crash at any time. I mean, I like buying tech and I believe in it long term, but you have to deal with the volatility of outsized returns. So I think these Canadian stocks kind of give, and same with SCHD. I think it's really important to have a diverse portfolio, not just focus on tech, just for those reasons, because there's nothing saying government intervention can't come into play at some point when it comes to our tech overlords. I think it's going to be an inevitability. It has to be, right? Canada, great country, but 3% world GDP. I know it's the growth is lacking here at best. It's purely real estate and immigration. And we've already screwed this country up enough. Let's be real. But anyways, folks, let's finish up with a few more questions here. Are you going to talk about VDY? We talked about bring back 10K. That's going to come very soon, I think. The TFSA, man, I feel like people don't utilize TFSA enough. There's so many loopholes and crazy stuff you can do with this account. Just make, you're not allowed to day trade, but if you're smart and you can get some growth, I think people overlack growth in their tax-free savings accounts. Because if you don't need dividends today, man, if you can get, the S&P 500 is up 400%. If you got that kind of growth in your TFSA over the last decade, like I have, the returns have been crazy. TELUS, I'll talk about TELUS in an individual video. The telecom giants have been getting wrecked, but I want to point out that they have been hitting record revenue numbers. So I think people are missing, again, these are, we're going to be recovery stocks. I still like TELUS. It's one of my favorites. You're getting almost a 7% dividend yield. Yeah, there's going to be some risk in the short term, but I still think it's a great buying opportunity here. People crap on stocks when they're down so much, right? They're usually pretty good buying opportunities. The problem with TFSA is the withholding tax on non-Canadian stocks. Yeah, but you don't have to buy those kind of companies, right? You can just buy growth companies like Google or like QQQ ETF and focus less on the income side. But again, who cares? Think about it realistically. Like if you're in a retirement like my parents are, like I would still buy SCHD in that account. Obviously, SCHD is better than an RRSP, but once you get to the age of 65, you have to liquidate your RRSP anyways. You can't leave it in there. I think there's a 5-year grace period to pull that money out. And then you got to pay full income tax on it anyway. So yeah, you're waiving the withholding tax, but you're losing it once you have to dedicate it toward income taxes. Well, you're probably going to lose at least 15 to 20% of it anyways. So at least with the tax-free savings account, yeah, you're paying 15% up front, but who cares? Because if you're drawing against that income for retirement, that's all you're paying. And a 15% income bracket on all that income, and that's it. There's no level up from there. You're just one bracket for the whole thing. That's pretty nice. To pay only 15%, it's really not that bad. But that again that's only if you're in retirement. If you're looking for growth, buy something like Berkshire or some safer growth-oriented companies, VOO, QQQs, and just be a little bit more growth-oriented in the earlier days of your I don't think it's that bad. Honestly, I think Canada, has the least amount of taxes when it comes to income. Canada wants you to be rich. I hate when people shit on the Canadian economy so much because Canada is really one of the greatest economies globally when it comes to so many things, and especially if you're income oriented and you're looking for growth in your wealth. It's kind of crazy that we have accounts where they waive withholding taxes. The U.S., I don't think they waive any foreign income taxes. You're talking about the TFSA, which you can draw against at any point in time in your life without being taxed on it. And if you pull all that money out, it fully counts toward contribution next year. So if you get a lot of growth and you pull it all out one year, guess what? You don't lose that contribution from now. And then every year you still get the extra bonus contribution from the government adds to it. And then even if you hold Canadian stocks outside of these tax advantaged accounts, if the Canadian company makes 50% of their income in Canada, you get a crazy tax deduction on the dividends. And if you hold growth oriented stocks, let's say Google or something outside of a tax advantaged account, you only get taxed on 50% of the capital gains. So half your capital gains are completely free. It's even if you're not using tax advantaged accounts, you're still able to print ungodly amounts of money at incredible tax rates. And you can kind of manipulate it how you want, right? I own a corporation and I look at that as, I'm going to let that corporation grow. And eventually I'm just going to take the cap gains. I'm going to waive any capital gains that are going to have to pay in my corporate account by paying it as a salary, because that waives any tax you'd have to pay out of a corporate account on passive income. And then I'll just do it when I don't have a job. When I'm in a low income bracket, I can use my corporate account like an RRSP. All those cap gains, all those capital gains, completely tax free, just like an RRSP, and then I just pay it out and pay tax on it later. Canadian corporations operate very similarly to an RRSP. There's so many tax loopholes, legal loopholes, that you can take advantage of. It's beautiful. Even with Canadian dividend, there's so much you can do. There's so much you can do here to get rich. And I just feel like people shit on it all the time. All capital gains should be free. I took the risk, I get the gain. Yeah, that's unfortunately not how the world works, though. I wish that too. It's funny that you don't get any tax. Well, I guess you do get some kind of tax breaks, I guess, to some extent with capital losses. But if you own real estate, right? You can do some tax write-downs and stuff, I guess. The UK version of a TFSA is 30K CAD per year. That's pretty nice. But again, I think Europe's got some pretty good accounts. I've heard a lot of good things in Europe. I just know the US, like the Roth IRA, like none of those accounts or the 401k are nearly as good and comparable. And again, like some of those states tax the hell out of you. US pays 25% in cap gains. Is that the entirety? That's a lot. That is a lot to pay. If you have to pay it on the entirety of the gains, ouch, for sure. You pay zero tax if your income is solely eligible dividends up to various maximums based on previous or based on a province you live in. Yeah. So, I mean, that's really nice as well. In your TFSA, if you buy and sell out of stocks every few weeks and keep taking gains when you do you think so if you're going to day trade, well, define day trading in a TFSA. The sad thing is there's no like ruling on exactly what is day trading or what is speculative trading, because then it's counted toward as operational income. And unfortunately, the government's like, look, we're going to let you make passive income, but if you're going to be doing it on a regular basis, like managing the holdings all the time, then they look at it as a job, and they don't want you using your TFSA for job-like income. And it's left up to a judge if you do get busted and you're making too much money. But here's the thing. If you lose money day trading in a TFSA, they're never going to come knocking on your door. If you make money trading or swing trading and you make too much money, that's when I speculate they're going to come knocking on your door. So you have to kind of leave it up to whatever that perspective might be. But I don't think swing trading is a big deal if you're holding stocks for, say, 3 to 6 months. I don't think they would come knocking on your door. So just kind of keep that in mind. Swing trading, I doubt. Spice is life. Spice is good. Where can I get started to become a financial advisor? Don't become a financial advisor. It's going to be wiped out here soon. I think the problem with financial advice is a lot of young people, thanks to Robinhood and Wealthsimple and YouTube and social media like myself, we're not getting the same kind of financial advice from paying somebody. And I know financial advisors. I think you just got to be careful with those kind of jobs. It's like being an accountant today is going to become very challenging, just because of artificial intelligence, and most young people, by the time, I don't know, I just feel like financial advisors are for the old people. Like I know a lot of older people and boomers that use financial advisors. I don't know a lot of young people that use financial advisors. So, I mean, I don't know. I thought about doing it myself. You can, in Canada, I think you can fast track it. It doesn't really take too long. I think Brandon Beavis has it. I know a lot of people do go and get it, but for the practical use case of it, I don't know. Maybe I shouldn't be saying that because I don't know if there's a job. Like, there's probably a lot of work for it still, but I don't know. It's like my accountants, right? Like my accountants used to have to do all the work, but now I'm using tools that output all my finances for me, so I don't have to. So I really don't have to. Like my accountant used to have to sit there and go through all my finances and actually like write this stuff down on a spreadsheet. Now they don't. Programs do that. They just take the end numbers and give it to the government. That's about it. So, I mean, that's a scary thing with financial advisors too. Like all those jobs are getting so systematically eaten away by social media and just AI tools. So I would just be careful with that as an opinion, not as financial advice or career advice. But ICSC has done nothing for me. Anyways, folks, I do appreciate the conversation. I hope you guys got to absorb some knowledge here today. TQQQ, TFSA, you're crazy. I do like the triple leveraged ETFs. I am fascinated by them. For those of you that have never seen them, I'd be a little bit more hesitant on holding them in a tax-free savings account because if a black swan event hits, as we've had in the past, it's very hard to gain back some of those returns. Over the long run, it's performed exceptionally well. But the problem is it's triple leveraged, right? So and not that it's ever happened in history, but if you get a crazy flash crash and in a single day, if the market drops 33%, this ETF is wiped out. That's the risk you're taking. And I mean, if you look at the pandemic, because you had consecutive down days, you crashed by like 80, 90% from the top. And you still haven't reached an all-time high yet, right? But if you zoom out on the long chart, it looks very beautiful. But it really only takes one really bad event. I mean, it could take a terrorist attack or just something horrible to happen, and you literally lose all of your money in one day. Because unlike a lot of ETFs, these triple leveraged ones, they reset every day. So every single day, it's like holding a brand new triple levered, bet against the QQQs. And again, it's highly, highly, highly unlikely. But again, if you get really bad markets with more consecutive down days than up days, it's really hard for an ETF like this to recover. So you just got to be very careful, right? You don't have to hold TQQ for very long, just long enough. That is true. But anyways, folks, what do you think about BTI right before I run off? And I was just doing the peace sign to get the thumbs up. We're getting balloons. I thought it was going to freeze. Everyone was saying it's freezing. Give me the thumbs up. Balloons, party, birthday. How do I get the balloons to come back up? VTI, you know, that's one that, you know, I think is considerable if you're into income-oriented stocks. It's probably one of my favorites of the tobacco sector. It has a much more stabilized, you know, stabilized smoking clientele because it's more globally diversified in countries where people tend to smoke more. And it's got a much better foothold in the you know, the vapor sector when it comes to like non-combustible cigarettes. So BTI is probably my favorite because everyone likes MO a lot, but I think MO is garbage. I think MO has like some of the worst management on the planet. BTI has been around for a lot longer, much more stable. Obviously, the stock's been trending down a lot, and a lot of people hate on it. But for a 9.75% dividend yield they can't afford is great. And I also recommend looking at things like MCAM Mortgage Group. This is also an interesting one that I've talked about in the past if you're looking for really high yields. This one pays 9.94%. Year to date is actually performing pretty well, only down by 1%. Long run has a good historical standard. It's been around since the 90s, early 80s actually, or mid 90s, sorry, and is up pretty reasonably for the dividend it pays. A lot of cool ETFs or stocks that aren't held in these ETFs like those ones as well. But well, at least while the balloons worked, I agree. So anyways, folks, great job. Like listening to your videos. All the best. You as well, good sir. I hope you guys have a great weekend and appreciate everyone for stopping in on a Saturday night because I got to go out for a birthday party dinner tomorrow. But stay cool. Stay awesome. Peace.